I think the greater risk by far is deflation.
But you're talking over a longer time horizon.
I'm talking about now too. Now, I don't think the public markets have this right at all. I think that we are in bargain basement territory.
Well, Michael Burry clearly does not agree with you on that one. Celebrity investor Cathie Wood is famous for her nearly $20 billion ARK Invest fund and for taking big bets on technology stocks like Tesla and Zoom or cryptos like Bitcoin. And she has become more and more vocal in criticizing the Federal Reserve's response to recent inflation, tweeting recently, "The Fed seems to be worried more about its legacy than the economy. It is ignoring deflationary and dangerous signals." In fact, Wood believes the Fed is being too aggressive in fighting inflation and will accidentally push us into deflation and a shrinking economy. Michael Burry, meanwhile, thinks the exact opposite is true and instead criticized the Fed for not taking inflation seriously enough for far too long. And these differing points of view have led to wildly different predictions for where the market is going next. Cathie Wood thinks technology and innovation is currently in bargain territory, while Michael Burry thinks that the worst of the stock market crash is yet to come. So who's right? Well, Cathie Wood made a name for herself in recent years when her fund ARK Invest was the highest performing ETF of 2020. But this success didn't last long, as the ARK funds actually underperformed just a regular S&P 500 index fund in 2021. And so far in 2022, it's been the worst performing US equity fund year to date. Michael Burry, meanwhile, is famous for correctly predicting every last major stock market crash. To list out some of the highlights, he correctly predicted the tech and telecom bubble of the early 2000s. He famously shorted the housing market in 2008, predicting the economy would collapse due to a bubble in real estate. And that bet alone net him $100 million in profit while making $700 million for his investors. And more recently in 2021, Burry was issuing warning after warning that the market was on the brink of collapse. And since that time, we have seen a sharp decline in stock prices. So hey everyone, FinTech here, and in this video I'm going to compare these two investors' predictions for what's next for the market based on the Fed's actions. First, talking about the underlying forces that put us into the position we're in today, with the Federal Reserve actively trying to slow down inflation. Then getting into the Fed's latest actions and what effect they will have on the economy, because if Cathie Wood is right, there is a huge opportunity to make money investing in technology and innovation. And if Burry's right, the so-called crash that we've seen in tech stocks is only the beginning and a much bigger crash is coming. And stick around until the end of the video to see what actions you can take as an investor to prepare yourself for either outcome. So hit the like button if you want, and let's start by talking about the underlying forces both investors have been watching like hawks that got us to where we are today. So the first fundamental force is inflation, which has been driving the majority of the Fed's policy over the past several months. The current high inflation that we're seeing was caused at least partially by the massive money printing by the Federal Reserve that kicked off the start of 2020. During 2020, the Fed ended up creating $4 trillion out of thin air to help support businesses and individuals through stimulus checks. But while this may have been a necessary step to stabilize the US economy, it had the side effect of inflating the overall money supply in the country. M2 money is the measurement of money in the economy, so things like cash, checking, and money market accounts. It's the measure of actual liquid money that people can spend. And in this chart from the St. Louis Fed, we can see how M2 money shot up in basically a straight line at the start of 2020. This had two basic effects. Number one, it made money much more available to people who needed it, and number two, it made the dollar less valuable. And we can understand why using the supply and demand graph. Simple supply and demand says that there is always an equilibrium point between how much supply of something there is and how much demand there is for it that sets the price. Ideally, we sit at this equilibrium right in the middle, and the price of the good is stable. But if the supply suddenly increases, the demand does not automatically increase as well. This causes the price to drop as the supply increases. Now, when we're talking about dollars, the price might still be $1, but the value that that represents can be pushed down if we have an oversupply of easy to obtain cheap cash, which thanks to the stimulus checks, we did. This situation led Michael Burry as far back as early 2020 to warn that we would see surging inflation coming out of lockdowns. But even after the Fed stopped their money printing back in November 2021, inflation has still continued to go higher and higher. The CPI, or Consumer Price Index, is the way that the government measures inflation, and its latest numbers show that inflation is up 8.6% over the past year. But what's causing the continued price increases? Well, that leads us to the other fundamental force that is affecting the economy, the global supply chain. The world up until 2020 was becoming increasingly globalized, with much of US manufacturing coming outsourced to China. But when lockdowns began, that global supply chain completely broke down. At one point in December, there were 96 ships full of containers of goods sitting offshore at Southern Californian ports just waiting their turn to be unloaded. Prices for commodities like lumber or oil hit nearly all-time highs during the last 2 years. And these supply chain shocks had a huge cost to them, which carried over into the rest of the economy in the form of inflation. Everything from home prices to the cost of running a business were getting more expensive. Now, Fed Chairman Jerome Powell took months to actually admit that the rising prices were not just transitory and to actually start classifying them as inflation, and taking steps to address it by raising interest rates. And this is where both Cathie Wood and Michael Burry's criticisms begin. Michael Burry, for one, thinks Jerome Powell was far too late in addressing inflation, and he thinks we are far from hitting the peak of inflation. Cathie Wood, meanwhile, thinks that raising rates to lower inflation is the exact opposite of what the economy needs right now. Because while we have undeniably seen increasing prices as shown in the CPI increasing over the past year, Cathie Wood argues that this is a lagging indicator that misrepresents the true state of the economy. And while the global supply chain was struggling before, it's now like a rubber band that's been stretched taut that is just waiting for the Fed to pull it a little bit too far before it snaps back, crashing the economy and sending us into a global recession. In fact, in a recent tweet, Wood said, "In our view, the US already fell into a recession during the first quarter." And she backs this up with a few different data points from across the economy.
I've never seen inventory surges like this in my career, and I've been around for a long time.
The first signal comes from the global supply chain, where Wood thinks that during the pandemic, companies were struggling to just get any kind of product out. And so they started producing like crazy, just trying to get something out onto the shelves. But now, even companies like Walmart and Target are reporting that their inventories are up 30% after those companies drastically overestimated demand. And if even Walmart can't properly forecast demand, what are the odds that smaller mom and pop shops were able to do better? This means that companies are going to need to cut prices to increase demand and clear out excess inventory. And we're already starting to see some of this at larger retailers. So in the same way that the lack of supply chain caused inflation, an oversupply is now pushing us toward deflation. And that's not even the most troubling indicator that Cathie Wood is tracking. She points out in another tweet that the yield curve, which measures the difference between 10-year and 2-year treasury yields, has flattened, which generally is a sign that investors have lost confidence in the economy's future growth outlook. In fact, a few months ago, the yield curve even inverted for a time, meaning rates were higher on 2-year bonds than 10-year bonds. And an inverted yield curve has historically been one of the best indicators of a coming recession, as Cathie Wood points out.
Every time the yield curve has inverted within 12 months to 18 months, we have been in a recession.
And so, with what she sees as looming signs of deflation or recession, Wood is worried that the Federal Reserve is way too focused on the lagging indicator of inflation through the CPI. But that hasn't stopped the Fed, who has used rising inflation as their main justification for actually raising interest rates on June 15th, which was the highest interest rate rise since 1994, which is good if we are actually seeing inflation, but could easily be enough to trigger a recession if deflationary forces are actually growing, like Cathie Wood says. But outside of a possible recession, Wood sees a long-term secular force that is actually having an even bigger impact on deflation, and that is the effect of innovation. And this is also where Michael Burry's disagreements with her become even more clear. Michael Burry has been critical of much of the technology sector for several years, particularly high-growth software-as-a-service stocks, tweeting last year that fads like Bitcoin, EVs, software-as-a-service, and meme stocks are like housing in 2007, and going on to trash other favorites of Cathie Wood, including her largest position in Tesla. At one point, Burry was actually shorting Tesla stock, and later, even after exiting his position, he defended other short sellers of the stock against Tesla CEO Elon Musk. But I think the event that really put Burry on Cathie Wood's radar was when he shorted Cathie Wood's ARK Invest fund last year, and Cathie Wood did not seem happy about that. In response to Burry's short position, Wood tweeted, "I do not believe that he understands the fundamentals that are creating explosive growth and investment opportunities in the innovation space," which for an investor is the equivalent of a WWE SmackDown. Now, Burry has since exited his short position against ARK Invest and even taken positions in some large profitable tech companies such as Google and Meta, while shorting other companies such as Apple. And he has continually referenced the dot-com crash of the early 2000s when talking about the current market, which is not a good endorsement for low-profit, high-growth companies which look like some of those early tech stocks. But while Burry did successfully predict the crash crash that happened back in the year 2000, Cathie Wood thinks that he's made the wrong call this time. Wood's ARK Invest fund holds tons of growth stocks, including companies like Tesla, Zoom, Roku, and Square, most of which have a ton of growth potential but aren't throwing off immediate cash in the same way a company like ExxonMobil might. See, Wood believes innovation is growing at an exponential rate, and it's all converging from multiple different areas at once. So as AI grows, it will follow an S-curve where it starts out slow, accelerates through its growth, and then eventually plateaus. But then this S-curve will feed into the S-curve of autonomous driving and EVs, or into genomics, which in turn can feed into new innovations, creating a cascading series of S-curves that quickly take on a life all on their own. And she also thinks with this innovation, we'll start to see more and more deflationary effects. Think about it in terms of your cell phone. Every year you expect phones to get better and better, and so old phones become less valuable over time. Well, this is just a form of deflation. And if you extrapolate that out to where every product, every service, every business is being driven by technological change, where old stuff gets cheaper over time, that could have a very big impact on deflation. Now, that's just Cathie Wood's theory, but Michael Burry again has an opinion and some choice words for Wood. Now, deflation generally means that the dollar is getting stronger or more expensive versus other goods and currencies. And the US dollar has fared much better than other currencies over the past few months, with top European CEOs seeing a potential recession forming in Europe and China probably already in a recession. But Burry doesn't take this as a sign of strength in the dollar. He recently tweeted, "When you see mention of the strong dollar, the almighty dollar, please remember this is only in relation to other fiat currencies." So something like the euro or the Chinese yen. The dollar is not at all strong, and it is not getting stronger. We all see it every single day in the prices of everything. So Burry is clearly not optimistic about inflation slowing anytime soon, while Cathie Wood is worried that we're gonna overcorrect and end up causing deflation. And quite frankly, either one could be right. We won't know for sure until after it happens. But maybe the more interesting takeaway is to look at the one prediction that both investors actually agree on, since if two people as different as this can agree on something, maybe they're right. For one, we know consumer sentiment has been at the lowest point it's seen since the financial crisis in 2008 for a few months now, meaning that general consumers have a very negative feeling about the economy as a whole. But new data from the University of Michigan this month shows that we've hit a new bottom, with consumer sentiment now at the lowest it's been since the Great Depression. We also know that the stock market is discounting growth stocks and moving money toward more value-based plays. And we know that even cryptos are not a safe haven, as assets values have started to decline across the board. So this, combined with negative GDP growth in the US last quarter, has led Cathie Wood to declare that the US is already in a recession. And Michael Burry agrees that there is likely a looming consumer recession. Part of the reason both investors believe this is due to the latest data on US personal savings levels, which is a measure of how much money individuals are putting away for savings. Well, US personal savings recently hit their lowest level since 2013, while consumer borrowing is hitting a peak that it has not seen since before the pandemic. So with consumer sentiment as low as it is, it seems unlikely that people are intentionally saving less money. It may just be that they are already feeling squeezed by the economy, and the people on Wall Street or at the Fed simply don't realize that the recession has already hit. But then what does that mean for us as investors? Well, Cathie Wood obviously believes that technology and growth stocks along with Bitcoin are at bargain prices and may be a safe haven going forward. Michael Burry, meanwhile, says to stay away from anything that isn't spitting out huge amounts of profit right now. And that's obviously conflicting advice, so if you want to, you'd have to pick who you'd want to follow. But there are steps that anyone can take to protect themselves if we do see this recession that both investors are predicting. So there's 3 steps that I would take to protect myself from a looming recession. Step 1 is to pay off any high interest debt over around 5% interest per year. And if you have debt on something like a credit card, getting that paid off as soon as possible will make you way more money than pretty much any investment ever will. The fact is, there's just nobody offering a 20% guaranteed return on investment that can offset the 20% guaranteed loss from holding on to something like credit card debt. Step 2 is to save up an emergency fund of 6 months' expenses that can cover you if you lose your job or you're unable to work for a bit. And step 3, just don't make any hasty investment decisions. If you want to invest, putting a consistent amount of money into the market market each week, and dollar cost averaging your way in has almost always outperformed trying to time the market bottom and dumping all your money in at once, or pulling your money out by trying to time a crash. And if you want a head start, you can even sign up for Moomoo Investing for 7 free stocks when you deposit $100. Moomoo has an active community where you can discuss and share stock trades, and it's super easy to get started using free educational video courses that are built into the app, while also offering more advanced features for those who are looking for them. So you can get those 7 free stocks when you sign up using the link in the description. Don't forget to like and subscribe, and I'll see you next time.